Hello and welcome everyone to Mint Money Conversations powered by DigiBank by DBS. As sometimes happens as Parkinson's law says, the one thing you don't want to happen sometimes happens. So my net connectivity may give out, but we shall do our best nonetheless. So with that, let me introduce our panel, and I go in alphabetical order. So we have Anurag Mittal, fund manager at IDFC Mutual Fund. Hi, Anurag.
Hi Neil, and thanks for having me here.
Then we have Asheesh Jain, senior vice president and head of investments and forex at DBS. Hi, Asheesh. Hi, Asheesh. Are you able to hear me? Let me proceed to our next panelist, Nitin Singh, CEO at Avendus Wealth Management. Hello, Nitin.
Hi Neil, thank you. Thank you for having me here.
Hello, Nitin. Can you hear me?
Yes, Neil. Hi, thank you. Thank you for having me here. Can you hear me?
And finally, we have Saurabh Bhatia, head fixed income at DSP Mutual Fund. Welcome, Saurabh.
Thank you, Neil. Thank you, and good evening, everyone.
Hello, Saurabh. Can you hear me?
Yes, I hope I'm audible.
Great. Yes, and the light has come back at my place. God is kind. So excellent. With that, I think Asheesh, can you hear me as well?
Yes, I can hear.
Brilliant. So I'm not sure if I was able to connect earlier, but I'll quickly run through the panelists, and we can begin with that. So we have Anurag Mittal, fund manager at IDFC Mutual Fund. We have Ashish Jain, senior vice president and head of investments and forex at DBS. We have Nitin Singh, CEO at Avendus Wealth Management, and we have Saurabh Bhatia, head fixed income DSP Mutual Fund. So welcome everyone, and thank you for joining in. Let me first give out the problem statement before I get into the questions. And really, the issue for Indian investors and savers at this point of time is a pretty serious one. Um, just as a benchmark, if you see the current SBI savings account rate is just 2.7%, and CPI inflation is running at 6.7%. So somebody who is completely risk averse is going to lose 4% this year. Most savings accounts are somewhere around the 2 to 3% range, and FDs are only slightly better. So in case of SBI, the highest FD is at 5.4%. So even there, you end up losing money. So really, the task before today's panel is to help people overcome the big challenge before them. One way to go, of course, is down the credit spectrum. So you take on some level of credit risk. And as I understand it, between credit and duration, which is taking on longer maturity paper, there are cycles. So some cycles are good for credit, some cycles are good for duration. So let me put this question to the fund managers on this panel. And I'll start with you, Anurag. Is the cycle turning back to credit? So if you look back at September 2018, the cycle clearly moved away from credit. There was 2 years of defaults and downgrades. Are we at another turning point?
Yeah, thanks, Neil. And it's a very important question, and especially like you said, with the interest rates on high quality credit products going down, it's a question in everyone's mind that okay, maybe this is the time to maybe go down the credit curve. Well, we believe that this is if you really try to assess the economic situation, when we started this year before COVID and now. Even if you take the consensus estimate, there is a 10% decline in GDP, which most of the economists and commentators are projecting. In simple words, it means a 20 lakh crores drawdown on the GDP. While this will be distributed across government, households, and corporates, but that's the kind of impact we are looking at the economy right now. And that's just the starting point, right? If you even look at how the KV Kamath committee report has identified the stress sectors, it has outlined about 26 sectors which are likely to face challenges, and that's just the direct impact. So right now, where we are in a suspended animation or in a standstill for most of the sectors. Uh, uh, Many industries are just at 60 to 70% of their previous COVID, where they were operating. So we think it will take a lot of time for economic activity to even stabilize back to pre-COVID levels. So this is absolutely not the right time to get into credit. This is the time for preservation of capital. This is the time to contain your risk, because we really don't know how prolonged, this corporate plus financial stress will really play out. How will this play out? You have a situation where you have an impairment in household balance sheets, you have an impairment in corporate balance sheets, and consequently, then you have impairments in banks as well as shadow banking balance sheets, which were anyways not strong. If you remember, even before COVID, even before when we started in March, even that time, economy was going from 7% to 5%. We were looking at various drivers. We were, scratching our heads that what will really drive growth for the coming year. And on top of that, we have had once in a lifetime kind of a macro shock to the economy. So this is absolutely not the right time to get into credit, no matter how attractive these yields look at us. Also, like you rightly said, uh, credit, unfortunately, sometimes we tend to kind of bucket sometimes with high quality credit portfolios. These are two separate asset classes, and sometimes we look at AAA to AA spreads or AAA to lower rated spreads, and we decide that okay, those have widened, and maybe we can look at them. But if you really look at the drivers of high quality portfolio and a credit portfolio, these are sometimes uncorrelated. Whereas a high quality credit portfolio works in a period of low growth, low interest rates. Uh, credit or a high yielding portfolio works as a cyclical asset class, which works in a period of stabilizing and then recovering growth, where the impaired balance sheets improve, where the leverage ratios start to come down. So they are totally sometimes chalk and cheese. So we should not first of all compare both these asset classes. And like I said, the macroeconomic situation does not warrant any kind of risk, especially on the credit side right now, given the uncertainty. So this is the time to preserve.
Okay. So we have a very clear answer there, that we shouldn't be getting into credit at this point of time. Saurabh, what's your view on this?
Well, from a layman's term, like we apply a logic from for duration perspective, that if the growth momentum is slower and government is borrowing relatively low, then duration will outperform. 2 years back, none of us spoke much about duration because government was borrowing a lot in early 2018, and and the growth was also relatively on a faster pace. So, if duration has the logic related to growth momentum and government borrowing, similar logic we apply to credit as well. For credit to turn good, you need positive growth momentum and lower cost of money. As things stand today, we have only one of the two things working. The cost of money is lower, but the growth momentum is still fairly plateauing at the lower levels, and hence the sensitivity to credit markets would have definitely reduced. But till the time yield curve is steep, as it is today. We expect the more risk reward to be more favorable on the duration side, considering the long end yields where they are, rather than the credit. And the first point which you referred to, the problem for the investors in fixed income. If we look through, I mean, again, this is part of the cycles for different asset class. But if we step back and look at what the central bankers are doing world over, it's not only with RBI. World over, the central banks are pushing investors to add the next layer of risk. Uh, and hence the short-term yields have largely collapsed, and there is very less to differentiate between cash deployment and incremental short-term investment. The next layer of risk in fixed income parlance confines to duration and credit, and till the time yield curve is steep, duration strategies provide more favorable risk reward before the next cycle moves into the credit space.
Sure.
Going that way, but a little too early at this stage.
Sure. So now let me turn to the wealth managers in the room. Here we are, the fund managers saying that duration is better than credit at this point of time, but the yields are really low. So that's one side of it. On the other hand, you have these issuances coming to the market. So there are these NCDs which come at yields of 8-9%. There are corporate FDs. One really popular one among retail investors is Hawkins Cookers, which gives around 8-9%. So Asheesh, let me begin with you. Should somebody just pick one of these high quality NCDs or corporate FDs as a way of solving the inflation problem?
So, Neil, this is a very complex situation, absolutely unprecedented times. And when we talk about fixed income, when we look at a retail investor, we have to remember that fixed income is what? It is Sunishtha Aay, which is fixed income, right? So when we are speaking to our customers, we have to be careful about it. We have to be responsible enough that we give them information which is enough for them to decide. And therefore, what we do is DBS, being the safest, has been awarded as the safest bank for 12 years in a row. We give them a perspective that there should be a certain amount of money which should be, from a 3 to 6 months, put and parked in a fixed deposit for any emergency requirement. However, at the same time, there are enough avenues within duration, and I will not even, just now go against what the fund manager friends of ours said. I don't think it's time for credit risk. But within the duration, you still have good companies, and I don't want to name specific companies, but they are AA plus, where the yields are very good. From my perspective, I would not go on specifics in terms of going and buying one particular NCD. My recommendation to a customer, I should say, my what I would refer to a customer would be that they go long, they buy a mutual fund, which gives them a duration play, and therefore over a longer period of, and now you can't really look at a 1 year. You have to look at a little broader. You can beat the FD returns beyond a 3-year period, given the fact that a mutual fund is much more tax efficient.
Okay. So Nitin, let me take this to you. Are there enough opportunities in the high grade credit space, whether it's directly through NCDs or corporate deposits, or indirectly through mutual funds that you can go for?
So I think certainly I'll just echo what everyone has talked about duration versus credit. I think, and I have a little bit of a different view, that whilst I think there is an opportunity in credit, but we need to be extremely selective. And I think that selective mentality will only come through investing into that sector. And that's not really available for the common man, because he doesn't necessarily have other expertise or the opportunity.
Sorry, Nitin, if you could be a little louder, that would be, yes.
My apologies. Can you hear me now? Yeah, okay. So as I was saying, I said, whilst I believe that there is an opportunity in credit, I also believe that that opportunity in credit cannot be placed through funds today. You have to be extremely selective about the papers that you're getting into, because I do believe that overall, from a credit perspective, given that while RBI has been managing, the volatility over the last few months, etc., but clearly we are still in a standstill. There's a lot of disturbance in the back. Could somebody go on mute, please? Maybe the other person. Yeah, yeah. Sorry. Yeah. So I think in my mind it's basically over across two or three pieces. One is that even though yields have come off a little, investors should look at options to lock in yields in the 2 to 3 year instrument space and therefore take advantage of a little bit of what's happening on the duration play. You have to be wary of credit risk and you have to be very careful about the instruments that you select. There are opportunities today. There are certain categories of alternate fixed income that do look interesting. Some interesting MLD opportunities coming from good, high quality companies where you are seeing a spread piece there. You are looking at opportunities like REITs and InvITs, as well as low volatility hedge funds, etc., that are there within the markets today. So there are various ways of skinning the cat. But I think in my mind, the simple philosophy is that if you have small sums of money, you should continue going through the mutual fund route, right? You don't have necessarily the capability, the expertise, or the time to be able to really find the right instruments, right? If you are a more sophisticated customer who has access, to sophisticated wealth managers, as well as the ability to be able to park larger sums of money, there are interesting options available on the direct fixed income side, which you should be looking at. You should look at locking in yields in 2 to 3 year instruments, but you have to be wary of credit risk and really look selectively at a combination of either MLDs or bonds or AIFs, etc., which would really suit your needs. I think credit from a mutual fund perspective is something that you should be wary upon, both because of the open-ended nature and what we've seen happen in the past, both with regard to outflows, etc., as well as with the diversified nature of the portfolio and what could go wrong in a few instruments. I hope, Neil, that was you could hear me.
Sorry, I had muted myself, as often happens in webinars. Nitin, could you explain what MLDs are and AIFs are for our lay listeners?
So one is of course market-linked debentures, and I mean MLDs or NCDs for want of a better word, are clearly instruments that are just another way of packaging, fixed income through a variety of issuers that are essentially working on it today. And I think that there is stuff that is available within the space, but clearly, as I said, it is again available mainly for high net worth individuals, and they should clearly be looking at it, because one of the biggest advantages for mutual funds historically has been the taxation perspective. And I think the reason why we've seen both on fixed income as well as equity over the last few years, really the resurgence has been the advantage of tax. And I think to a large extent, currently most large HNI, UHNI customers are getting wary of remaining invested in blind pool vehicles like mutual funds and are moving into the direct space. So I think there is clearly an opportunity from market-linked debentures, which are either linked to various benchmarks, etc. The second one that's a very interesting opportunity lies within the alternate debt space, which is basically looking at close-ended vehicles like AIFs, etc., that actually invest into either performing credit or into venture debt, etc.
Sure. Sorry, just to explain to our readers, so AIF would have a minimum investment of 1 crore. Sorry, please go on.
Exactly. Yeah. I think the second piece really is that compared to traditional credit funds, which have invested into papers of varying credits, etc., but have the open-ended nature of it, they are protected and buffered by the fact that these are instruments that you tend to hold for anywhere. These are funds that you tend to hold anywhere from 5 to 10 years. You are able to really live over the life cycle of the investments that you've made. You don't need to worry about liquidity within them, and it's something that we are seeing greater prominence of within customer portfolios. So. Clearly, customers are looking for. Everybody is in the search for yield. I mean, people are very hungry for yield. I think the point that you made originally, Neil, is very true. People are saying that the traditional ways of investing in fixed income, where you earn 2-3%, really doesn't justify. In fact, a lot of people are saying that today, when customers get liquidity, if somebody sells this company, a very valid question is, why don't I just keep it in the bank account rather than putting it into a liquid fund? And it's actually difficult to answer that question at times. So I think the space for direct fixed income is opening up. The space for the fact that you will have low cost alternatives and debt ETFs is going to open up. And the space for a lot of these alternate debt instruments is also going to open up. And as is traditionally the case, it starts at the higher end with regard to HNIs and UHNIs, and over a period of time it gets democratized.
Yeah. So before we move on from the credit risk topic, there was one question submitted by a user, Ravinder Juneja, about bank perpetuals. The most common type, I believe, is 81 bonds. There was a huge issue with Yes Bank when those 81 bonds defaulted. But at the same time, they've made something of a comeback in the market. So even PSU banks issue these bonds, and people normally perceive PSU issued bonds as less risky. So, Ashish, can I bring you in on this? Are bank perpetuals something for people to consider from the bigger, safer banks, could you say? Sorry, Ashish, can't hear you.
I think I was put on mute by the host. Okay, now can you hear me now? All right. Okay, so definitely, I would say there are certain banks, especially on the PSU side, where government ownership is beyond 80%, and they are giving yields or YTMs as high as 11.25%, and therefore, there are definitely opportunities, especially on the PSU bank or larger private banks.
Sorry, Ashish, could you also speak up a little?
Okay. So what I wanted to say is that definitely there's an opportunity there in the PSU bank space in the perpetual side. There are certain perpetual bonds which are giving returns as high or YTMs as high as 11% plus and have a government holding of 80% plus. And therefore, there is definitely an opportunity there. And there are certain large private banks as well, where the returns may be a little lesser. But again, I would definitely say that is a good opportunity to be.
Sorry. Coming to the big question in the room. Sorry, Nitin, were you saying something?
Sorry, I think the only point that I want to add over there is that whilst there's an opportunity, people need to realize the nature of the instrument, and I think both Saurabh and Anurag can spread a little bit of light on it. People believe that for a public sector bank and the fact that it's 80% owned, at the end of it, the perp is not a traditional fixed income instrument. And I think Yes Bank really showed in terms of how that story can play on. So, with risk always comes return, and I think it's very important for people to have a sense of it. So really, for me, even if people want to get into perps, and sophisticated customers should, as part of their portfolios, they need to be very aware of the risk that goes into it, and not just look at the fact that it's government backed, etc. For there to be a safety net over there. I think Saurabh and Anurag can throw more light on that.
Yeah, absolutely. Fair point. Saurabh, please go ahead.
Yeah, from a perpetual point or perpetual bonds or the 81 bonds, like the well guys mentioned, Nitin and Ashish, around the benefits, pros and cons thereof. One aspect which becomes very pertinent for these instruments to be part of a mutual fund portfolio, because it's an open-ended fund which needs one important factor beyond credit and holding is about the market liquidity. So the first filter what we apply for non-perp is the entity which you look at from a solvency point should be at peak in terms of the risk of uh, the risk of solvency should be the first thing which should be considered, and second is the extent of market liquidity. A few just because the government owned can pass the first filter, but the second filter becomes very tricky part, and hence confining to select names, because eventually for any instrument it's identified by its valuation or by the prices which markets determine, and these two filters largely help to uh, to filter out the extent of uh, these instruments which give you both, which help to mitigate both these risks, which is on the solvency side as well as the extent of market liquidity. And as you mentioned, this year there's been a lot of noise around this particular instrument, and the entities or the banks who met through both these filters were easily tradable in the worst of times, be it March second fortnight or April last week as well.
That's interesting. So the fact that they remain liquid even in that very tough time. Anurag, do you want to add something to this?
I think, like Saurabh rightly mentioned, but just a couple of points. I think any investor uh, who looks at 81 bonds needs to look at that. Ultimately, these are hybrid debt instruments with a loss absorption feature. So, obviously, in a bankruptcy kind of situation, there is a possibility of a write-off. But even in a non-bankruptcy situation, there is a possibility in case the capital ratios are not adequate. There is always a feature in these bonds that the interest or the annual payment could be withheld, and it's not considered a default, or the bonds could not be called on the call date in case the bank cannot find a better quality capital. So from those, I think investor needs to be aware that firstly the call date should not be considered just that it will be definitely called, or the interest payment, like sort of talked about liquidity. There are obviously sometimes liquidity challenges. So as long as the investor is aware of all these issues, and then also they are willing to come according to the risk appetite, I mean that's a different thing. But for one should certainly not just look at the YTM of these products and just assume that they will get that realized returns.
Sure. And just to explain to our listeners, YTM is yield to maturity. So it gives you a rough idea of the return of the debt fund if you deduct the expense ratio from it. Great. So let me move then to the big question in the room, which is are we close to the bottom of the interest rate cycle? Saurabh, could you begin on this? So,
Perspective. Uh, Interest rate cycles play out in three phases, and remove all the macro names and macro indicators. Am I audible?
there's a bit of a lag, Saurabh, but if you can be a little louder, that would be great.
Am I audible?
Yes, yes, you are. I think there's a bit of a lag at Saurabh's end. So let me pass the question to Nitin. How close are we to the bottom of the interest rate cycle?
Sure. Am I audible now? Okay. From a layman perspective, we say, leaving all the macro parameters aside, to answer this very important
Hello, Nitin. Would you like to take up the question? Okay. Anurag, I think we'll have to begin with you.
Thanks, Neil. I think on the interest rate side, as even the governor has mentioned, there the utility of further interest rate cuts is not really meaningful from here on. So if you see, the main focus of RBI has now moved from rate cuts to more transmission of the previous rate cuts to to the government bond yields, to the loan rates, because the last, if you really look at the current market situation, the overnight rates, because of excess liquidity, the overnight rates are well below the policy rate of 4% or the repo rate of 4%. So and they're actually close to 100 basis below the policy rate. So the incremental 25 or 50 basis will not really move the needle. And if you look at the 10-year benchmark, it's trading at 6%. So what it's more important from RBI perspective is to keep on doing its unconventional measures, whether in the form of Operation Twist or open market operations buyback, to keep to bring down market interest rates, or to at least ensure a smooth transition of government borrowing program. So to be honest, we really don't expect too many rate cuts from here on. I think the intervention from RBI will be more towards market measures of interest rates, rather than just working on the policy rate.
Yeah, that's a very good point, that there have been many rate cuts, but perhaps there isn't enough of transmission into market yields. And in fact, we've had a question on this. So this is from Chetan Gill, who's a Punjab-based financial advisor. He says that some fund managers argue that the difference between the repo rate and the 10-year yield is averages at 90 basis points historically, whereas currently it's 200 basis points. So will the 10-year come down, or will the repo go up?
So if you look at where 10-year yield was before the pre-lockdown and pre-RBI's policy measures, the 10-year was trading around 640 in February, and it's still trading at around 6%. What it is reflecting, and this is despite record rate cuts, this is despite record liquidity, despite the HTM hike, which is held to maturity, which banks can keep in the books. What it is reflect is the the heightened uncertainty on the ongoing fiscal situation, and also supply on both the center as well as state level. So till that supply overhang remains, I think yield curve could remain steep for a while. Till and like I said previously, RBI is focused more on smooth transition of the government borrowing program, rather than having a specific yield in mind that it really wants to take interest rates at. As long as there's a smooth follow through of the borrowing program, what seems like that RBI is okay with the current range of yields. So this to just summarize it, I at least we think that this yield curve could remain steep for some time.
Okay. On a related note, and this is more for the wealth managers. So Asheesh, I'll start with you. There are savings accounts, there are FDs in some banks which offer quite high rates. I recently did a piece on it, and then I tested it on myself. So I went and opened an account in one of the banks. It's still in process, but is this one way to go for savers to get more yield, for more bang for their buck?
Against the fixed income instruments on the debt side, right, on the mutual fund side. Obviously we have, when we talked about the fact that it is fixed income, a fixed deposit gives you much more certainty in terms of returns. However, you get comfort from the fact that mutual funds have also performed very well on the debt side. Now, important part is you definitely can look at these particular fixed deposits or normal savings accounts which are giving high return. But taxability is what we have to keep in mind. So if you're looking at a shorter term, definitely an FD makes sense. But if you're looking at a longer term, I would say a debt mutual fund makes more sense because of the fact that it is more tax friendly.
Yeah, that's a fair point. Nitin, what's your take on this? So many of these savings accounts and FDs are in slightly smaller banks, slightly newer banks. There's always that worry in the back of people's minds that, oh, what if the bank defaults? Um, is it worth a shot in the current environment?
No, I completely agree. In fact, and I think you answered the question itself. I think investors should look at savings accounts or bank deposits for a 6 month to 12, 18 month segment. I think not longer than that. But it's very important not to go deep down the risk curve in banks. There is a reason why some banks offer higher rates compared to others, and I don't really need to get into the details of it. And I think the one piece that people must realize is there is no guarantee from the regulator, as is widely assumed. Yes, in the past, the regulator has come to the table, the whole piece in Yes Bank, at the end of it turned around right. But at the end of it, what people have to remember, and I had mentioned this earlier as well, which is that you have to balance risk and return, right? It does make sense both from a saving account perspective and a bank deposit perspective from a short term. But I think clearly don't go down the risk curve in banks, right? Continue to balance the two together, and you'll be fine.
Yeah, yeah. So on a related note, there are these set of government instruments called small savings. One of them in particular I want to discuss to begin with, and then we can broaden it to others. So they are the RBI 7.1% floating rate bonds. So as the name suggests, these currently pay 7.15%, but the rate is floating, so it'll move up and down with general interest rates. And if I look at the spectrum right now, I mean, it seems to be a pretty high rate. I must confess, I went and told my mother that you invest in this. This is pretty safe. You'll get a floating rate connected to inflation. So, I mean, that aside, can I get some views from the panel on this? So, let me open it up. Let me start actually with you, Anurag. Although it's not really for a fund manager, in terms of fund management, but I'm just curious. What do you think of this kind of instrument, this kind of rate?
Uh, like you said, it's a floating rate, and it will move in tandem. Our government continues to regulate this, but I think an investor needs to assess their liquidity and taxation. So if while the credit risk is virtually not there because of the being a government bond, there is a liquidity constraint. So as long as the investor knows about the liquidity constraint that that they cannot liquidate these bonds in the market and they will have to hold for a certain period. Plus, if it suits their taxation, I mean, obviously these are very attractive instruments there right now.
Okay, Asheesh, can I bring you in on this?
Of course. So I think Anurag answered it. So there is a reset clause on these RBI floating rate bonds, giving you a return of something like 7.5% right now. But they get reset every 6 months. They can get reset every 6 months. Okay? And the fact that there is a lock-in of 5 years. So it is in the hands of the investor to whether they are okay with time duration as long as 7 years and have that element of certainty and uncertainty there while credit risk as Anurag said is negligible. But at the same time, the uncertainty of what it can get reset to is something which the customer has to decide if the customer is okay with it.
Sure, that's fair enough. The other government instruments that are quite popular are the PPF, the National Savings Certificate. There's a whole host of them, and usually they tend to be a little bit above bank rates with the government guarantee. So, Nitin, why not just go for one of these?
No, I mean you should. There is, as we say, it is not an either or, right? Pieces like PPF and NSE all have a part in your portfolio. They all have a certain amount that you would typically invest to get your, especially in a PPF, etc., to get your tax advantages. And you must. I think the only point is that when you start looking at larger sums of money, they clearly do not offer value on a post-tax basis. Mutual funds still continue to do better on a post-tax basis as well as from a liquidity perspective. But yes, I mean PPF, NSE, all of these are part of a customer's portfolio. They should all be taken in various allocations.
Yeah, absolutely. So one related issue, because in mutual funds the return is market linked, but the fund management industry has come up with the sort of intermediate product which is roll down maturity. It's a strategy which schemes across the board have adopted, including IDFC. So Anurag, let me begin with you. Can you explain what roll down strategy is and how it works? How is it good? How is it bad?
Sure. So a roll down, strategy is kind of a defined maturity where the maturity is set in a kind of a range of dates. So, for example, let's say a product is a 3-year roll down to start with. So let's say you start the product in January of a year and it's a 3-year roll down. So it ends in January to March of 2023. What the fund manager does in a roll down strategy is that they maintain that static maturity. So every month, that maturity of the fund should come down, and so the investor can basically match their investment horizon with the maturity of the roll down of the product. So it kind of gives a certain predictability and visibility to the investor of the tenor of the product.
Sure, sure. Saurabh, is this the future? Is this the way to go?
I think we can't hear
Well,
Saurabh.
this
Maybe
is
maybe why don't
certainly one of the options for a fixed income investor, ideally to meet his expectations on investments through his horizon of investment. Of course, he he attains to tick the four boxes: liquidity, predictability, returns, and lower volatility. I'll repeat: liquidity, predictability, returns, and lower volatility. If you tick these four boxes, largely your expectations on fixed income investments are met. A roll down fund largely helps you to tick the boxes for liquidity, predictability, and lower volatility. Liquidity doesn't imply the need for volatility. Am I audible now?
Yeah.
Am I audible now?
Yes, you are, Saurabh. If you could speak up a little bit, that would be great.
So why don't I, whilst you're waiting for Saurabh's connection to become better, I can maybe chip in here. I think as Saurabh said, it
Am I
is it
audible,
is a
Neil?
part of the arsenal for mutual funds. I think the pro of that product clearly is that you know the kind of maturity curve that you're participating in, you know the kind of papers that are getting purchased, right? So that makes a big difference, right? I think, and just picking up on what Saurabh was talking about the four pieces, I think the con clearly is if there is a chance of an interest rate risk, the flexibility to lower duration is not there, right? And really, what you have to see is that can mutual funds really stick to the discipline till the end of the roll down is yet to be seen. I think this product has been there for a while. It has picked up a little bit of weight now, but it's been there for a while. And I think just echoing what Saurabh was saying, it would form part of the arsenal for any fixed income investor to some extent. So it's not again, as I said, it's not either or. Everything has a part in the portfolio, and so should this. Sorry, Saurabh. I stepped in when we could hear you clearly.
No problem. Thanks, Nitin. Um, so, you know, there's one other part of debt funds that has become quite popular of late, and that is ETFs. There was a major ETF launch around 6, 7 months ago. They are low cost, you get a sort of fixed yield. Ashish, what is your view of debt ETFs?
So I think those are a good.
Okay, I think there might have been a bit of an issue with the connection. Anurag, can you go for it?
Sure. So yes, I mean they have seen a lot of investor interest, like you rightly said. It's from a cost perspective. So most of the ETFs that have been launched recently have been AAA PSU oriented, and that's kind of given investors a lot of comfort on the credit quality that will be there in the those kind of products. So that's one confidence that which gives to the investors that at least I know the credit quality in these products, that there will be control, there will be control on the maturity. These are listed on exchange if I want to liquidate some portion of my portfolio. So although it's yet to be seen how whether investor can execute a quantum size on the exchange, but yet there is an option. So that all this attractiveness is bringing investors, notwithstanding it's a new product, but yet investors are preferring the credit quality and the low cost uh, of this. And since these funds also have a defined maturity profile, investors knows the horizon for which they can look at these funds.
Sure. Ashish, do you want to complete what you were saying
So,
about debt
I
ETFs?
think these are good products, and they, additionally to what Anurag was just talking about, I think most importantly they also give you liquidity. The only difference is you need a demat account, etc. So from a retail investor's point of view, it makes the documentation a little more complex. Whereas on a mutual fund route, it is absolutely simple. So that's the only difference there.
Sure. Saurabh, I think you're back. So let me get your view first on roll down maturity, which DSP also has in some of its funds, and then we can talk about debt ETFs.
Sure. From a roll down perspective, I was referring to, for a fixed income investor, what he needs to meet his expectations through his horizon of investment is to tick the four boxes, which is liquidity, predictability, returns, and lower volatility. I'll repeat: liquidity, predictability, returns, and lower volatility. Liquidity doesn't imply the need for money. Liquidity implies the ability of the investments to reset when the interest rate phases change from high to low or vice versa. And herein, the roll down plays a very important aspect because it ticks these three boxes, which is liquidity, predictability, and lower volatility. But you need an open-ended fund to optimize your risk for the returns, and hence the best investment what we recommend is to apportion between roll down and open-ended. So roll down is definitely a very important aspect to have from your fixed income allocation, but it is not the only aspect to have. And lastly, from a roll down, what we believe is it's important to get the right starting point for your roll downs. If you end up starting a roll down to relatively lower yield, you can get a fairly predictable profile, but there's a fair amount of opportunity loss. And hence, the starting point of the roll downs become very important. And hence, we recommend roll downs which with a relatively shorter tenors, and the starting points to be at relatively elevated yields.
Yeah, so that's a good sort of way out of being locked into a fixed yield for too long a period of time. Absolutely. And how about a debt ETF, Saurabh?
Well, again, now if I want to tick these four boxes, a debt ETF alone cannot help me tick all the four boxes because it also uh, it is just a one more option. It is just one more option available. But if I match it up with a roll down plus an open-ended fund, or a ETF plus an open-ended fund, largely I get my desired result. So just the way roll down becomes an important aspect along with the open-ended, the ETF is just one more option available. But from a fixed income standpoint, and to tick these four boxes, I think a roll down and open-ended works in the long run.
Sure. So, since we're running out of time, let me give each of the panelists a fair amount of time to solve the problem before Indian savers today. That that yields are low, inflation is high. You could end up locking a low yield for a long period of time, or you could end up going down the credit risk curve and suffering the consequences. Um, so, Anurag, let me start with you. If you can give me a roadmap as to how an Indian investor can solve this issue.
Right. I think so. Well, on the inflation front, we do think that this is a short-term disruption, and inflation should do come by end of this year, and next quarter inflation should come down. But from an overall framework perspective, we think that investor still has to allocate majority of his allocation, although the returns could be slightly lower than what he's used to in the last 12 months. The majority of the allocation has to be in the core bucket, which we call, which is basically high credit quality and low or a medium term maturity profile. Because if you see, majority of the investors, like we discussed, are still fixed deposit investors, so they prefer a low volatility uh, product, both from duration as well as credit risk, which can be done only in a kind of a core bucket, which is your high quality short term funds, low duration fund, money market funds. While the rates, the returns or the yields which those products are quite low at compared to the historical levels, but that's something which we think that they will have to live for some time. A small allocation, depending on their risk appetite, whether it's duration or credit, can be allocated maybe in a credit-oriented strategy or in a dynamic or a gilt fund. But majority of the allocation has to be in that core bucket. And as long as that framework is held across interest rate cycle, it will help them overall deliver a better return. If you see, most of the allocation which happened to credit funds, which we saw the impact in 2018 to to this date, happened post demonetization, when AAA yields fell down, and investors were looking for that extra carry, and that is when most of the misallocation happened. So this is the time that investors have to be really careful. This is the time to stick to basics.
Yeah, absolutely. Well put. That investors shouldn't be pushed by central bank easing, by low yields into risk. Stay the course, but perhaps a small amount of the portfolio can be put into something that matches your risk profile. Is that a fair summary? Okay. Um, Ashish, let me come to you. How would you approach this big puzzle?
So what I would tell my customer is that you have to really, there are array of products, right, which have an element of risk and an element of return. So the customer has to really look at their risk profile and the time duration they want to invest in. Within these parameters, you will get enough opportunities wherein you can play on a short-term curve, to an extent duration, stay away from risk, and get various options in each and every time duration. So depending on the risk profile and the duration to invest in, you have good options, and that is what we will we can provide in terms of suggestions to a customer to invest in across duration as well as credit risk.
Yeah, fair enough. Nitin, can I come to you on this?
Sure. Can you hear me now? Yeah. So I think the most important piece of fixed income is really the tenure with which these investments are being looked at. I think within the short term for and I want to be very specific with regard to what we tell, because I think at the end of this call people should go back to the message around what they should be doing. I think the short term deployment strategy has to be very clear, right? There are basically three avenues. If you have a clear liquidity bucket, you can look at parking money into bank fixed deposits or corporate fixed deposits, as we spoke about previously, but good quality, not bad quality. I think traditional liquid fund investors can look at moving up a notch to ultra short-term funds, etc. Right? Because I think for investors who are looking at deploying for the shorter term, arbitrage funds continue to offer a better post-tax realization, and that's something that they should be looking at, right? I think the interesting piece really comes from the longer term in terms of whether you want to be in a hurry to lock in returns, and how you really want to look at it. I agree with Anurag that back to basics makes sense, and I think there are two pieces that should be happening over there. One is that if you're clearly seeing an additional spread opportunity available within the 2 to 3 year segment, then clearly investors should look at investing within either a mixture of short-term corporate bond, banking PSU funds, or at direct options, which I spoke about, be it either in MLDs or selective bonds of companies. And I think lastly, from a strategic perspective, certain categories of alternate fixed income look very interesting. And these include both REITs, these include InvITs, these include low volatility hedge funds, as well as alternate debt products. Right. So a typical portfolio has to be constructed in that manner. And if you're able to do that, the right allocation, with the right asset allocation, people talk about asset allocation being fixed income and equity, but it's not that simple. If you're able to construct a balanced portfolio in that manner, then you'll be able to tide over and answer the fundamental question that Neil, that you pose, saying what should customers do during this time to maximize yields whilst at the same time minimizing risk.
Yeah, absolutely. So it's basically a variety of strategies. There's no one simple answer. You have to
Yes.
look at each. Yeah. Saurabh, can we get your views on this?
Sure. See, firstly, if it's a problem, then there has to be a solution. Uh, how we put across from a fixed income or for any asset class is, from a fixed income perspective, very simple strategy called FIRE: find, invest, ride, and exit. I'll emphasize a little bit more on find and exit the strategies. Uh, because you have only three avenues to earn your returns in fixed income, which is conventional short term, which Anurag and Nitin mentioned, duration, and the credit. Now, it's more about finding these opportunities when they work, and when they don't, which is when you need to pick the exit button. When the yield curve is flat at elevated yields, your duration tends to outperform. We saw that in September 18 or 2013-14, etc. In phase two of interest rate cycle, typically the curve steepens, and through this phase, the conventional short terms outperform. And in phase three, when the yield curve flattens at lower yields, is when credit outperforms. And it's more about identifying these three phases. And rate cycles always play out through these three phases. And anecdotally, if you observe, the cycles have turned when the yield curve is flattened at relatively lower yields. And hence, with keeping this from a layman perspective without going into macros or any other aspects, the shape of yield curve is what drives returns in fixed income. A change in shape of yield curve is what drives returns in fixed income, and hence a roll down plus open ended will help you get the best of both worlds, because in fixed income, to derive returns, you need accrual or you need capital gains. If you get both, it's a bonus. So roll down will take care of the accruals, and open-ended will take care of either the capital gains or maybe higher yields. And hence, roll down plus open-ended, which can enable you to navigate across the three phases of the rate cycles.
Yeah, absolutely. Very eloquently put. So there you have it, viewers. Different solutions, one big problem, but hopefully we've been able to shed some light on it. We will help you solve it, and it's been a fantastic panel. we've all had our lockdown connectivity issues, but you don't have to worry about that. We will be taking many of the ideas that have been discussed here and writing about them. So you'll have all that explained to you and mentioned in print as well. So thank you very much, everyone, for joining, and
Thank you.
happy investing.
Thank you.
Thank you, Neil.
Thank you.
Thank you,
Neil,
everyone.
and thank you all of you.